Hello, John Gillespie here with Occam's Investing, your AI-powered stock valuation platform. Today, I'm going to start off by walking you through my CLAUDE.md file where I've codified my investment philosophy. And then once we get through this part, we'll go and I'll walk you through an NVDA DCF and peer review, since pretty much you'd have to be living under a rock not to be familiar with NVIDIA and possibly a little bit excited about what the company is doing. So in any case, this is a copy of my CLAUDE.md file. We start off with my investment philosophy. Follow the cash, not the narrative, because profit's opinion and cash is fact, right? So you can't engineer cash. But GAAP and EBITDA and all the rest of those things really don't give you a good feeling for how healthy the company is. My core beliefs are most retail investors trust analyst ratings without questioning the assumptions behind the rating. I know because I was one of them 30 years ago and lost plenty of money when I was relying on analysts to tell me what to buy and sell. They don't take the time to understand the company, its market, and what assumptions, if wrong, would make this a losing pick. Both the upside and downside case must be articulated and tested. What has to go right for this to be a 10-bagger? What has to go wrong for the thesis to break? And then we have a signal hierarchy. There's a number of things that we look at to determine if we want to buy or sell, right? So it's cash flow, balance sheet strength, consistent earnings growth, reasonable valuation, and our insiders buying. We picked these things from little nuggets that Peter Lynch and Warren Buffett have shared over the years. And then we have the kill criteria. When are we going to walk away from an investment? A lot of investors don't have an exit plan when they buy a stock. And even if you want to hold it long term, you should understand, hey, if the story changes, what am I going to do? Right? So one of the things is deteriorating fundamentals, right? Is the gross margin going down? The reason the stock was purchased no longer exists. Your thesis is invalid. Price has outpaced earnings, valuations stretched beyond fundamentals. That happens frequently, especially in capital-intensive businesses like NVIDIA and AMD. And then we have a zombie score, which basically lets us know if a business is down to having less than 12 months worth of cash runway. Don't hope and pray for these companies to be saved. More often than not, they will go belly up. And then we have a number of sectors that we cover. Real estate investment trust, funds from operations, adjusted funds from operations are help determine what they can afford to pay out for dividends. So we have this, and same thing with BDCs, right? Business development companies, Basically, people buy those because they want the income stream, so it's important that we understand how safe they are. And banks and financials really shouldn't be in the standard path, so I'll be developing a bank-specific path coming up soon. Over the years, I've held a number of banks. I currently don't have any in my portfolio, one of the reasons why Occam's is short on this path. And then we have energy pipelines, dividend health, the track record. Are they dividend kings or queens? Have they been increasing their dividend on a regular basis? And how likely are they to actually have to stop paying it, right? If you're relying on an income stream, you don't want to have that happen. And then we have software as a service companies and tech. Right? So we have Rule of 40, which we have modified a little bit. It's operating cash flow based. And revenue growth plus OCF margin gives us our Occam score. And then we have the standard for all other stocks that don't fit these categories. We have a standard path, which you can get a DCF and peer comparison. And cash flow is the primary indicator of health. And we have our forensic jury in all of these cases that basically will give you their opinion of any of the valuations that we put forward, so that you'll help you understand, as opposed to just getting a paragraph and saying, oh, buy this. The jury potentially will debate. They might have conflicting opinions. They'll tell you why. And in the end, you'll get a conclusion. And basically, for income-focused sectors, REITs, BDCs, pipelines, people own them for income streams. So we evaluate them on dividend health, coverage ratio, payout sustainability, distribution, growth track record, right? And then every analysis template basically must contain these sections before a verdict is issued. So the company story, right, something that is very important for investors to understand. What is the story that this company is bringing forth to the market? What's the investment thesis? Why would I want to buy it? What is the market not considering? Why is this a good company to be into? And a financial snapshot, right? So the revenue, earnings, cash flow, growth rates for the trailing 12 months. And key ratios: gross margin, return on assets, return on equity, payout ratios for dividend payers. And we have our Occam's forensic score, which is really primarily based on cash flow and earnings quality, and the zombie/divergence checks, right? So is income, is expenses going up faster than income, right? So we will tell you that they are getting closer to be a zombie. It's not going to be the last minute fire sale. And so you'll get could get a DCF valuation up here, an industry analysis, the bull and bear case, and a final verdict, right? And so the thing that we're pretty proud of is that we're offering 3 lenses versus giving you just one point of view. So when they all 3 agree, we have conviction. When they contradict, we flag the conflict and explain which signal to trust more. And then we have some other interesting parts of our model, right? So we have the Buffett rules and the Lynch categories matrix. If you look, we have a detailed page on our website. We ask you to, to indicate, what your risk tolerance is. And the Lynch categories goes into fast growers, slow growers, stalwarts, cyclicals, turnarounds, and asset plays. If you haven't read One Up on Wall Street, I recommend that you definitely get that book. I mean, it's been out for a long time. It's one of the first investment books I read, probably in the early 90s, late 80s, early 90s. And basically, it's almost a Bible. And then you have Buffett's validation metrics, must pass per category. Hard to argue with his track record, and these metrics are pretty important, right? And then we have kill signals. These are the things that basically tell us that it's getting to be time to walk away from this particular investment. And for risk tolerance verdicts, right? So back to Peter Lynch's categories. For different category and your risk tolerance, you will have different reasons why you might want to sell. And so our model, once you indicate your risk tolerance, can help you and understand, hey, if this is a fast-growing company and your risk tolerance is aggressive, then you're good. If you're conservative, maybe you want to get out of it. All right, so now I'll walk you through a valuation of NVDA. We'll do the DCF, and then we'll do a peer evaluation. So the DCF valuation from NVIDIA comes back as a hold. A lot of people might say, hey, just as a darling stock, what's up with just a hold? It's all about the assumptions that go into the valuations. It comes back with an intrinsic value of only about $70. The current market price is about $176. So one of the things that Warren Buffett was always big on is this concept of margin of safety, right? So the difference between where the market price currently is and where the DCF says it should be is going to put you in one camp or other, strong sell, or in this case. But don't just give up. There's a lot of information to be had here, right? So I would caution people not to make their decision just based on the first the first piece of information. In fact, if you see, it's, even though it says strong hold according to DCF up top, we have a moderate confidence that it should be a hold. The assumptions of weighted average cost of capital, the growth rate, and the Occam score based on operating cash flow margin is an elite, and we've got no conflicts. So our AI forensic juries all will give you the same opinion. You'll get the detail if you keep scrolling down, right? So the AI analysis, this is a fast grower. This is something that you want to be thinking about if you like Peter Lynch's style of investing. And then there's the Buffett factors. We capture 7 of his metrics, and with NVDA, 6 out of the 7 metrics pass. So if your risk tolerance is aggressive, and mine is, this would be a buy. And you could basically size your position based on your conviction. The idea here, this card here tells you what would Buffett do, right? It's close but not clean. Buffett would want cash to be greater than debt, and he would pass on this before committing. And you keep scrolling down, we're getting into the confidence moderate, the intrinsic value, the current price. Occam class is elite because it's R40 score is 113. The weighted average cost of capital is 17.5% with a beta of 2.38. And the growth right now is currently 22.66 with a terminal rate of 3%. So we have a bias check, right? So the growth rate at 22.7% is aggressive, right? So our DCF diverges greater than 50% based on an FMP estimate, which would be $240. So the AI valuation narrative gives you some business trajectory. NVIDIA stands as the undisputed king of the AI revolution, having transformed from a gaming GPU company into critical infrastructure provider for artificial intelligence computing. And it goes on. However, this extraordinary performance raises sustainability questions. The company trades at 61 times earnings despite generating fortress-like cash flows, suggesting the market has priced in continued hypergrowth, while NVIDIA's technological moat remains formidable through its CUDA software ecosystem and chip design leadership. The 22.7% perpetual growth assumption appears heroic even for a company of this caliber. The semiconductor industry is inherently cyclical and competitive, like AMD, Intel, and custom chips from hyperscalers pose medium-term threats for NVIDIA's current dominance. Right, so I personally have experience. I've invested in a number of the chip companies, and I've got caught holding the bag too because their cycles run pretty quick. When the earnings dry up and the margin starts to go, even there's a whiff of the margin going down, the price craters. Right, so I basically, while I've made money on AMD and NVIDIA, or a couple of those stocks, I actually had to hold them longer than I really wanted to for the price to recover. And then basically we have the DCF versus the forensic assessment. The forensic assessment is based on 4 different AI engines that we have give us an evaluation. And for NVIDIA, they're unambiguously positive. It earns an elite Occam score of 100 with 0 flags, demonstrating genuine operational excellence rather than financial engineering. And I'm not going to read all of this to you, so you can actually head out to the website and check it out yourself. You can run free valuations on companies of your choice. And basically, signal conflict resolution. I trust the forensic cash flow analysis more than DCF conclusion here. The DCF's 17.5% weighted average cost of capital appears punitive for a company with NVIDIA's balance sheet strength and cash generation. However, the magnitude of overvaluation indicated by the DCF cannot be ignored entirely. So at current prices, investors are paying for perfection and assuming NVIDIA maintains its current trajectory indefinitely, which history suggests is unlikely in a cyclical semiconductor industry. Right, so basically we have a final verdict of hold and confidence of medium. And basically you can go down, there's more stuff, there's a bull case and a bear case. And then basically after you go through the bull and bear case, the AI jury actually gives a verdict of a buy, right? And the relative valuation versus its peer is fair. NVIDIA trades in line with peers on valuation metrics. And the Buffett validation, and it's a fast grower, so basically there's only one metric that NVIDIA doesn't pass for. Its cash is not greater than debt. Semiconductors are capital intensive. And the DCF assumptions, this is the information that if you were going to double check the DCF provided, these are the assumptions that you would need to run against it. And so based down here below, these things are just cards of other valuations that community members have taken. And you can always go out and just click on one of them and bring up the valuation for that company if you're interested. And then just a little bit more for NVIDIA's the peer valuation, the relative valuation. So here's details on the peers and the metrics, percentiles, metric by metric comparisons. Key observation, NVIDIA's quality metrics are not just best in class, they are in a different league entirely. Its return on equity of 104% dwarfs the next best peer. Taiwan Semiconductors at 35%. Its return on invested capital, 63%, is more than 2.5 times TSM's, which itself is second place. Meanwhile, on earnings and cash flow multiples, PE and price to free cash flow, NVIDIA is actually toward the cheaper end of its peer group. And what does the 50th percentile mean for valuation composite? It sits there, meaning it's priced in line with the average peer, neither a screaming bargain nor egregiously overpriced on a relative basis. This is somewhat counterintuitive given NVIDIA's massive absolute multiples, price to book, price to free cash flow, but the peer group is expensive across the board. And just looking through, so conclusion on quality versus value. There's no discount warranted here. NVIDIA's fundamentals argue for a premium to its peers. Yet on earnings-based multiples, it trades at or below the group median. This is a high-quality company at a fair to attractive relative price within the peer set. Right? There are no negative flags present. Two peers meaningfully distort the composite, so basically for the relative valuations. And then we give you the actionable conclusion. So NVIDIA presents a rare combination of top decile quality metrics at a below median valuation on earnings and cash flow multiples within its peer group, with a fair composite verdict, understanding that the quality advantage relative peers like Taiwan and ADI, who offer far inferior returns on capital. The primary risk is not relative overvaluation, but rather the absolute growth expectations baked into the $4.3 trillion market cap. Any deceleration in the infrastructure spending could rapidly reprice even a fundamentally superior business. Right? So that being said, you probably want to have an aggressive risk tolerance if NVIDIA is going to be in your portfolio. And that's all I have for today. I'll probably be, for the next few weeks, be running through at least one company a week. But feel free to come out to Occam's investing website. You can see it at insightfulagents.ai. And go through and try some things out. We give free valuations, and you can also sign up if you like to be able to have access to the entire portfolio of benefits. And that's all I have for today.